Hi, everybody. Welcome to another evening of answering some TikTok questions live on financial advice. Good evening and welcome to you. KLM, KL54. Wow. Tepsa, KG, T Danny. Hello, guest Dr. Mukhade. How's it? Hello, Donna. Thank you, Donna. I'm so glad you think it's awesome. Karen Basson, goeienaand. Zipala, Evolution, Godman. Good evening, folks. You know how it works. Please let me have questions and let me see what I can answer. Bear with you in a second. Just need to grab something here. How's it, kitty cat? It is getting colder and colder and colder, and it literally feels as if my nose is running all the time. And I know it is not, it is literally just the cold that makes it feel like it. I'm sure you all know what I'm talking about. So, have anybody asked a question while my back was turned? Doesn't look like it. Good evening, ST. Any questions there? Anything I can talk to you about in terms of financial advice? Let's see if I can be of assistance. Donna says, I have an RA for about 3 years now and would like to take my tax rebate and put it back into the RA. So Donna, when you do your annual tax returns, when you do your annual tax returns, the rebate is given to you by SARS. So let's say you earn 10,000 Rand a month and you paid exactly the right amount of tax that you're supposed to pay based on the PAYE bracket, then you should be breaking even with SARS. You should have exactly nothing payable back to you or them paying you anything. But if you've got this retirement annuity now, then SARS would say, okay, you paid us exactly the right amount of tax, but your contributions to your retirement annuity was X amount based on your tax bracket. Let's say you're on a 31% tax bracket. We have to give you 31% tax back. And in that situation, SARS will actually give you the money back. And then when you receive it back in your bank account, that is when you take it and you put it back into your retirement annuity. As I would assume you've got a financial advisor, you speak to your financial advisor and you ask him to help you because it's paperwork. Alternatively, you can contact the company, but they're always going to refer you to an advisor, even if it's a desk advisor, as we call them, to assist you. And that's how you do it. And Donna, that will be one of the best things that you can ever do, to put money back that you get as a rebate into your retirement annuity. So, well done to you, Donna. If you're going to do it, absolutely fantastic. Absolutely fantastic. Can I take a life cover over my mother with me as the premium payer and beneficiary? Yes, you can indeed. There's absolutely nothing that stops you to do it. You have to show or prove that there's a financial relationship between you and your mother. But that is normally not a big issue. So yes, you can, as long as your mother is happy to sign the documentation to apply, and as long as she is happy to go and have the necessary medicals done that goes with it, then there is absolutely no problem. You can take out the life policy on your mother's name. And I know people don't want to hear this because it sounds like we are cold-hearted, but it is literally one of the best investments that you can ever make. And parents who actually love their children, they won't mind if their children do something like this because they know that I'm going to die in any case. This is to my child's benefit. So there you go. You can do so. Okay. The life cover we've just addressed, and Donna's retirement annuity we've addressed. Let's see, have I skipped somebody? Oh yeah, Donna, so just by the way, you won't obviously get 3 years rebates in one go. You will only get that specific year that you are in. You will only get the rebates for that specific year paid to you by SARS. Okay, so there we go. Let's see who else. Is it possible to move your tax bracket if you are getting a total package? So no, you can't really move your tax bracket. What has to happen is, as you move up and down in terms of income, you can obviously move from a lower to a higher tax bracket, or far higher to a lower tax bracket, because everything in terms of tax brackets is dependent on your actual income that you're earning. Now, if you get a package, yes, I do believe that if the package is structured in one way, it could mean that you're in one tax bracket, and if it's structured in a different way, that you're on a different tax bracket. So it's absolutely possible, I would say, to move tax brackets depending on the structure of your actual income that you're going to be earning. Now, with regards to that, I can't tell you too much about it because that's not my specialty. There, I would advise you to speak to somebody that deals with packages, so somebody that has knowledge in HR, or alternatively an accountant that understands how these different benefits that you can get on packages works. And they can then help you to structure a package the way you want it. And then, of course, it will just depend on the employer that you are working for or contracting to, whether they will be willing to do the package in that manner. So let's see, lots of people coming on. Oh, and then I skip 1 or 2 or 3 again. And then I have to go back and find out who was the last person I answered. Although tonight it seems like a lot of people are joining, but not a lot of people has asked questions. And good evening to everybody here that says hello, hello, hello. Good evening, good evening. And then people send gifts, and I don't know what these gifts mean and what they are. I wish I could convert these gifts into money. That would be nice. Let's see. Okay, I think we are right through the last person that's joined now. So let's see, what is the next question here? Leon, how's it, Leon? Is it a good idea to buy your medicine cash rather using your medical savings and submitting receipts? Leon, I can't really tell you whether it's going to be better or not, because at the end of the day, what you can write off for tax, okay, is medical expenses. But if you've got a medical aid, doesn't matter whether the expense has gone through the savings account of the medical aid or whether the expenses come out of your pocket. It is your medical aid expense. Once again, this is something that a tax specialist will be able to answer better for us. I would say, Leon, this is my opinion. If you do have a savings portion on your medical aid and you can afford to buy some stuff cash or whatever, then it's nice to do so, because then you know that your savings is protected and left there until next year, and it rolls over and rolls over. So what you can then create is you can actually create yourself a bigger savings portion that in a crisis year, when you've got really a lot of expenses, or you've got a bad financial year or whatever, that you've got this big savings account that you can actually use and use and use until it's used up. So I think it comes down to a bit of financial planning for every person, whether it will make sense to them to do it or not to do it. There is no real benefit, or not, what's the opposite of benefit? There's no real anti-benefit, so to speak, by doing it the one or the other. I think it all depends on your personal needs and what you can and cannot do. Donna, is there a better tax-free savings account as the one your bank offers, or the interest you can get? Oh yes, Donna, absolutely. If you do a tax-free savings account with your bank, you are basically receiving whatever the interest is that the bank is offering you. You can do tax-free savings investments with every one of the investment houses out there. Old Mutual, Sanlam, Liberty, Coronation, Marriott, Allan Gray, they all have tax-free savings offers. And what makes them better for me is the fact that you can go and choose a portfolio. So you can go and choose a portfolio, local, international, medium risk, high risk, whatever, and you can then get the growth that that portfolio earns you. So I like the Global Equity Fund. I've mentioned a few times from before. If you've been on that fund for the last 25 years, you would get an average of 14% return on your investment. So if you had a tax-free savings account in the global equity fund, you would be getting 14% growth on your tax-free savings investment, substantially better than the 4 to 6, 7% that you would be getting at the bank. So yes, you can move your money from where it is in the bank to a different investment, and you can definitely do substantially better. Rushan, hi there. Would you advise on selling my Telkom shares? Rushan, I don't know what gives people the idea that I do share trading. And I wish I could answer you, but I really don't know, because I don't deal in buying and selling of shares. As a matter of fact, I don't really even watch stock prices and whether they're going up or down. Same as with gold. I don't really care whether gold goes up or down or anything like this. The reason that I say I don't care is I make recommendations in terms of investments, and I work with the client to determine what that client's strategy is. Now, when we say what the client's strategy is would the client want something that's more conservative because they want to protect their money and they're not so worried about growth? Or is the question of, we've got a long time and I want to pursue growth as hard as possible, so I want to take a very aggressive fund? So we decide on a strategy, and depending on what that strategy is, and we normally call the strategies an inflation plus 1 to 2, inflation plus 2 to 3, inflation plus 5 to 7, inflation plus maximum. That's what we call the strategies. So that is basically how we determine how much growth you are going to try and get in the investment that you're going to do. So once we've determined that strategy, then I link your investment with portfolios that is in line with that strategy. And that's what I do. Now, the portfolio manager that runs this portfolio, he and his team of people that works with, they're the ones that are responsible to check stock markets, see what the political influence is doing to stock markets and to share prices, whatever the case might be. And they're the guys that needs to know whether it's good time or a bad time to buy or to sell a certain stock. So it's a bit of a long explanation, but I thought I'll position it because I've had so many people asking me about it. Okay, let's see who's next. Need help with tax return? Any recommendations? So Dash, my accountant that I use and have been using for many years, I find their company very good, and because we try and give a total package to people, I normally refer people to my accountant. His name is Nico Besson, and his company is Tundra, and he then does people's tax returns for them. And what makes it good for us in our company is that we work together with the accountants as well as the lawyers. So when somebody comes to us, we do their financial advice. We've got the lawyers that helps with their wills and trust that's needed. We've got the accountants that can handle all the taxes. And because these three professional people talk together all the time, the client that makes use of our services knows that he is speaking to a team that's working together to give him the best result, instead of working with an accountant this side, a tax practitioner on that side, whatever the case might be. And these people are not talking the same languages and not basically talking against each other. So there you go. Nico, I hope you're online because I've just punted you, Kazi. What's your take on taking a residual when you buy a car? ST, it is the worst idea in the world. As a matter of fact, you should be trying to buy cars cash. No, it is very bad to put a residual in the car, and I'll tell you why. The majority of people, and when I say the majority of people, I mean the majority, most probably 99% of people, they do not save up the money that is necessary to pay that residual at the day that it comes due. And then what they have to do is they have to refinance that vehicle and the outstanding debt again. So you pay a lot of interest because you're paying off your debt much slower. So you're paying more interest than normal. Then you get to the point where it was supposed to be paid off and you haven't paid it off and you don't have the money for the residual and now you have to refinance it and you once again have to pay it. No. Taking a residual it's dumb. That's my personal opinion. Go and buy a car that you can afford then. Most people that buy a car with residual is because they can only afford a Toyota Tazz, but they want the Volkswagen Amarok. And that's literally what it is. Vehicle is not worth that money. Okay, that is my little rant for the evening. Thank you. Leon says, thank you. Much appreciated. Medical savings for retirement. It's true, Leon. It's true. One of the scary things is that our inflation rate has been around about, and I know everybody is going to say this is impossible. It's not like that. 2.8% for the last year or two. Okay. Don't kill the messenger. That 2.8% is what is declared. I work on a inflation rate of 5 to 6%. That is much more reasonable. But medical inflation rate is normally 3 to 4% higher than that. So if you work on normal inflation of 5 or 6%, your medical inflation is going to be close to 8 or 9%. Just the way it is. And that has an influence on planning for everybody. Awesome. Thank you, Donna. Let's see who's next. ST says, I believe in maximizing the opportunity on the retirement contributions, reinvest SARS rebates. Absolutely, ST. This is the thing. If you make use of the rebates that SARS gives you on your retirement annuities and you do reinvest it, you can, I'm sorry, there's no investment anywhere in the world that's going to be better. No investment ever going to be better. So reinvesting your SARS rebates on your retirement annuity, absolutely brilliant. Even if you don't put it in your RA and you put it on a different investment, the fact that you're reinvesting it is fantastic. Leon says, imagine school taught us about tax and compound interest saving. Leon, I cannot agree with you more. I took accounting when I was in school. And when I think back on accounting, I realized that we did the same stupid journal entries for 5 years in a row. I don't think I learned anything more in matric than what I learned when I came into high school in, what's it today, grade 8, standard 6. And that's something that we often discuss and that we often say we would like to create a school where kids are taught business and taught these type of things, practical stuff that will help them in life instead of learning biology or history or something that they're never going to use again in their life. Okay. Chepo says, I just got 11K from MTN. What was that for? Did you sell my shares without me knowing? Chepo, I don't know, but these are those wonderful share opportunities that places like MTN and Vodacom and whatever gives to people, and normally it falls unfortunately under BE, Black Empowerment. So I honestly don't know. It could be dividends, but for you to get 11K in dividends, I suppose you will have a substantial amount of shares. But yeah, Chepo, I don't deal with shares. I don't know. I don't actually know this specific MTN Zagele Footy share project that they've got you into. So I can't tell you. I recommend that you go back to them and you ask them, okay, all the best. And enjoy the money. But enjoy it right. Go and reinvest it. Enlightened Spirit says, hi Coronation, is Capital for Life a good place to do investments? Capital for Life. Capital of Life. Is Capital of Life a business? Let's see if we can find something here quickly. Capital of Life. trying to type on the long distance here. Capital of Life. Capital Life. I see there's a Capital for Life Index Universal. My mate, I have never heard of Capital for Life. I see it's Capital for Life, not Capital of Life, nie? But Capital for Life shows that they are winners in 23 on retirement planning, on estate planning, Chartered Institute. Seems like they are a very good company, and they are in the UAE, South Africa, and the United Kingdom and Australia. So I would assume that they know what they're doing. I cannot see if I have a quick look here. I cannot see so quickly if they've got their own funds. So I can't tell you if they've got their own funds. But from a company perspective, if I just look at the front page of their website, it seems like they are a solid company. I see they've got stock market protected investment here. So yeah, it looks like a good company. And at the end of the day, the company is as good as the advice that it gives and the products that it sells. So if this Capital for Life is one of those independent brokerages like a lot of other companies are, I've got an independent brokerage, then normally it depends on the product which is sold. And if the products that they are selling is recognized and good financial products from recognized financial institutions, then absolutely. Then it's all going to depend at the end of the day on how good the advice is that the advisor gives you. So I cannot tell you anything more about this company. But it looks like they're pretty good. So give it a shot. And if you're not happy, this is the one thing with regards to a company like this. If you are not sure whether the company that you're dealing with and the advice that you're getting is good or is the best, then you get a second and a third opinion. Listen, I know financial advisors does not like it when you get a second and a third opinion. But at the end of the day, it's your money. It's one of the most important decisions that you have to make in your life. And advisors cry when there's 2 or 3 of them that has given advice and the client picks one and leaves the other 2. Yes, the advisor cries. But at the end of the day, it is your money. You have to do what you believe is best. So if you can trust the person and the company that you're dealing with, shouldn't be a problem. What is the fastest way to pay off a 30-year home loan bond? Donna, the fastest way is to put extra money into that bond. That's as easy as that. Literally, if whatever you can put into that bond additionally per month, that's what you do. If you get bonuses once a year and you can put that in there, that's what you do. That is the fastest way to pay off a bond, is to go and pay extra on that bond. There's always going to be the possibility, sorry, almost said the opportunity. There's always going to be the possibility, Donna, that you could have, let's say you would put an extra 1,000 Rand a month into this bond and it will bring the bond term from 50 years down to 25 years. There's always a possibility that if you took that 1,000 Rand, you put it into an investment, that the investment return could have been better than the bond rate that you were paying. And if that is the case, then it would mean that if you were investing the money and not paying off the bond sooner, for all intents and purposes, the extra 1,000 Rand would have brought your bond down from 30 years to 25 years, but doing the investment, you would have saved up enough in 23 years already to pay off the bond. So there's always that possibility. But the but that I have is at least you know with the bond, you know exactly what you are getting as a return, because your bond interest rate, let's say your bond interest rate is 10.5%, then you know for every 1 Rand that you put onto your bond, you are saving 10.5% interest on that 1 Rand. So that's the simple way of looking at it, Donna. Who's next? Hi, please, G.I. Jane. Hello, G.I. Jane. Hi, please help me. I have 6 million rand. It's now at liberty. Where can I invest with more growth and save? So, G.I. Jane, you're going to have to speak to a financial advisor so that one can sit down and help you make decisions as to where you put that money. And the reason why I'm saying this to you is when you invest with any company, it doesn't matter if it's Liberty or Sanlam or Old Mutual or Momentum, whatever. It is not the company that you're with that determines whether the growth that you're earning is good or bad. It is the underlying portfolio in your investment and how well that portfolio is doing that determines whether your investment is good or bad. But I cannot give you advice on an open forum like this to say, listen, take your money, go and put it with company XYZ because they're going to be much better. Because I don't know what your needs are. I don't know how much time you have to leave the money there. If I say to you, listen, take that 6 million rand, go and put it in a very aggressive portfolio that's going to give you 14% return on investment over the long term, and you only want to invest it for 1 year, then I am in deep trouble. Because if that portfolio takes a dip in this year, you're not getting 14% return, you may be getting minus 20%. Because that portfolio is a good portfolio that could go up and down, but the intention is invest in me for a long time because you will start low, go up and down, but always end high. Now, I cannot tell you which portfolio to go into if I don't know how long you've got to invest, when you need the money, how aggressive you can go with your investment. So set up an appointment, get a proper consultation, get proper financial advice, and then be guided by that advice. But can't ask it like this, G.I. Jane. In any case, contact me in my WhatsApp profile and then I'll help you. It's a pleasure, Jepo. Anytime, sir. Anytime. Cree says, what's your thoughts about an offshore endowment in USD? My tax rate is greater than 3%. Cree, it is a wonderful investment. I do lots of those. I do a lot of those offshore investments, endowments, and it is wonderful for a number of reasons, depending on which company you use. The endowment is structured in such a way that you can do multiple withdrawals in the first 5 years, where on a normal endowment, you can only do 2 withdrawals in the first 5 years. On these offshore investments, you can do multiple withdrawals. The second thing is that on these offshore investments, the capital gains tax in the portfolio is only 20%, where local life investments, the capital gains tax is 30%. You can nominate beneficiaries on those things. And one of the most beautiful things is because it's endowment, because it is outside of the borders, it doesn't form part of your estate anymore. So yes, absolutely brilliant investments. I love those. I do them on a regular basis. Cree says my timeline is 20 years. Oh, Cree, mate. How much money do you have? How much money do you have? Because if you can invest for 20 years and you're going to do it in an endowment such as that, you're going to be smiling all the way to the bank. I promise you. I promise you. Thanks for your response. Only a pleasure. Okay, ST says, I invest more than 240,000 per year in retirement. Can I start a trust and make it a sole beneficiary? So ST, you can start a trust whenever you want. But making this trust the sole beneficiary of the retirement annuity, that's not really going to work. And the reason why it's not really going to work is, remember, on retirement annuities, when you nominate the beneficiary, a retirement annuity is the only product where the trustees that's overseeing that retirement annuity must decide whether the beneficiary that's nominated should get the money and qualifies for the money. Because if there is financially dependent people that is more dependent on this retirement annuity, it is a basically law that the trustees must look after that person. So let's say, for example, you nominate your wife as a beneficiary, and you and her have lots of money, there's no shortage, but what you had is you had a squeezer on the sideline, and you had a child with this person, so you had an extramarital affair with another person, you had a child, and that person as well as that child of yours, they are financially destitute. They battle to get to make ends meet. Then the trustees has a legal obligation when they see that your wife, who has got plenty of money, is not the beneficiary that receives the money, but rather this person that you had the extramarital affair with and that has the child. The trustees must then allocate the funds, if not everything, a big portion to that person. So if you nominate a trust as a beneficiary on a retirement annuity, it's not a natural person. The chances are very likely that the trustees are going to say, sorry, we're going to have to look for somebody that is financially dependent. Only if we get to the point where we honestly can say that there is no person that's financially dependent can we make the money pay over to the trust. But it doesn't really make sense, because now you're going to put the trust income, or you're going to put an income into a trust. For what reason? You're not saving anybody. The trust is much better utilized for assets. So properties, investments, vehicles, businesses, that's what you want to put in a trust. You want to put it in there so that you are protected. If you do go bankrupt in your individual capacity, your assets that's in your trust is protected and is secured. That's the one thing. And the other thing is, because everything is in the trust, there is no estate duty payable on it in the event of your death. So if you want to start a trust, start it for the right reasons. That is what I'm trying to say to you. But when it comes to retirement and retirement annuity, I don't think the trust is the option for you. Mark Lee, hang on a second. Your question was there and then it jumped away. I have some money I would like to invest with Allan Gray. Which portfolio will be advisable? Mark Lee, mate, I think I've now mentioned this 3 times tonight. I wish I could tell you which Allan Gray portfolio will be the best. I wish I could tell you which Allan Gray investment will be the best, but I can't. Not because I don't know their portfolios. I know all their portfolios. And Allan Gray has a lot of nice and good portfolios. But I need to know how long you invest for. How much are you investing? How much risk are you willing to take? How liquid must the funds be? How quickly can you get hold of it? So there is a lot of different factors that impacts where you are going to invest the money. Whether you're going to put your money into a conservative Allan Gray investment where you're going to get 8% return on your investment, or whether you're going to put your money into a very aggressive Allan Gray portfolio where you are going to get 12, 13, 14% return on investment. If I do not understand your personal circumstances, then I cannot tell you where to put the money. And that's what I do as a financial advisor. I have to sit you down, get all your information with regards to your assets, liabilities, income and expenditure, how much risk you can take, your financial dependence. I have to understand all of that before I can make a recommendation to somebody like yourself. Okay, Mark Lee, I hope that helps. G.I. Jane, 6 million invested at S&P. I don't know what the S&P is. Are you talking about the S&P 500? Very possible. That 6 million that you were talking about, G.I. Jane, depends on what product it's in. It could be in a retirement annuity, a unit trust, an endowment. There's a variety of investments it can be in. The portfolio, the underlying portfolio could be a portfolio that is an S&P 500 portfolio. And the S&P 500 has been doing well. So if you're saying that your investment is not doing well while it's in there, well, then I don't exactly know what you're expecting, because you're already getting good return. But Jane, yeah, like I said to you, you're going to have to find somebody to give you financial advice. It's the only way to determine if your investment is actually doing okay with Liberty, if you can make changes there, or whether you have to move the funds. Open say, risk investment, 70% ends in a person losing money. It's a scam. Open, you obviously have absolutely no clue what you're talking about. I do apologize for stating this so bluntly. But no. High risk investments that 70% of people lose on, that is Ponzi schemes, gambling, starting a business. That is high risk investments, like in very, very high risk. When we talk about investments in our world and the portfolios that we talk about, and we talk about high risk portfolios or aggressive portfolios, those portfolios, in how many years have I been doing this? In 27 years that I've been a financial advisor, I have not had one client lose 1 cent or get a negative return on investment. So you're completely wrong. As a matter of fact, aggressive portfolios only always do good. As long as you keep to the rules, okay? As long as you keep to the rules of investment. If you say you're going to do a 5-year investment, stick it out. If you're going to do that and you got proper advice, you will see a positive return on your investment. A lot of time people do an investment and then they suddenly need money, or they're scared of what's happening in the market, or whatever the case might be, and then they withdraw their money, and they withdrew their money just as the market was taking a dip, and then they want to cry about how it's a scam and how they lost their money. Think back to 2020 with COVID. I advised all my clients not to move their money. The stock exchange took a dive, 35 to 40%. Lots of people withdrew their money. They were crying because now they withdrew 30% less at that point than what it was worth just a month before. And then what happened? 6 months later, the market recovered, and everybody whose investment dipped by 35 to 40% suddenly had 40% plus in their investments. So open, don't talk nonsense. I keep on saying this to people. If you don't know what you're talking about, rather get advice, rather get educated than making statements like this. Okay, open, and I'm more than happy to help you out, eh? Absolutely. Donna, I have 100K. Where is the best minimum risk? Donna, have you not been listening to what I've been saying tonight? Okay, so what I'm going to say to you, Donna, is the following. In terms of medium risk investment, let's look at this. If you go and you have a look at all the portfolios that Old Mutual have on their platform, so in their investment house, they most probably have, I think conservatively, I would say they've got about 20 different medium risk investments. Now, if you go to Sanlam, you're going to find that Sanlam has something similar, and let's say they've got 10 of these. Then you go to Allan Gray, and Allan Gray has 10 medium risk investments. So it starts stacking up. So what I'm trying to say to you is there is most probably in excess of 300 medium risk investments in South Africa. I cannot tell you which one is the best medium risk investment, because this year Old Mutual's Balance Fund is the one that does the best, and next year it is Momentum Balance that does better, and the year after that it is Sanlam Stable Fund that does better. So it's impossible to tell people which is the best medium risk investment. What you have to do is you have to choose the medium risk investment with the company that you feel comfortable with, invest your money and forget about it. You might not have the best return, okay? But I promise you, it's going to be pretty much in line with everybody else. And there's going to be some investments that's a bit better over the time frame that you invested, and some that's a little bit less good. But you're going to get returns. The idea with investments is always to beat inflation by a percentage that you want to beat inflation with. We all want to be in the best investment, but I don't have that crystal ball to tell people which is the best investment. Mulalu, you've got 100K with a timeline of 5 years. So Mulalu, you and Donna both have 100K, and both of you want investments, and both of you want advice as to where to put the money. I cannot tell you. What I can tell you guys is you are more than welcome to contact me on my WhatsApp number. I'll put you in contact with one of my advisors in my office that deals with investments on a regular basis. They can set up a quick 20 to 30 minute consultation so they get the basic information in order to do a planning session, and then they can make recommendations with regards to medium risk investments or aggressive investments depending on what you need. I promise you they will give you good advice. What is next? Wow, how many have we skipped now? Oh, there we go. Chepo says, I'm 40, I want to invest 25k till I'm 45. Where should I invest? Oh, Chepo. Oh, mate. I'm going to tell you exactly the same that I've told everybody with their 100,000s and 6 millions and everything, and where's the best place to invest. It doesn't matter whether you are investing a monthly investment or whether you're doing a lump sum like they're doing. I need to sit down and have a consultation with you in order to determine where is the best place to put your money. I cannot give you an answer in an open forum like this. It will be absolutely irresponsible of me. So I'm not going to tell you, Chepo, but I'm once again extending the offer that you can contact me on my WhatsApp number, and I will gladly arrange for a consultation with myself or one of my advisors, and we can give you proper advice. Okay, there we go. Genevieve Ferris, good evening. What happened to the trust if the trustees passed away? So Genevieve, in a trust, when a trust is set up, it normally says in the trust, not normally, it should always actually say in the trust, how new trustees are elected. Now, I normally advise people to have at least 3 trustees on a trust. And therefore, if one passes away, the other 2 can then go ahead and appoint a third one. But if you have a trust whereby there's just one trustee, which is not advisable for a variety of reasons, then in that trust, it will specify how a new trustee must be elected and appointed. So, irrespective of how many trustees and how many pass away, the rules with regards to the election of the new trustee will be in the trust. Dr. T, 500,000, which short-time portfolio should I go for? Dr. T, I'm not going to answer this again. Folks, you need a consultation. If you want to invest money, it doesn't matter how much, you need a consultation for a financial advisor like myself to understand your circumstances, and only then can I give you advice and can I make recommendations. I can't tell you. Some people can take 500,000 today and they can go and invest it in alternative investments, which is high risk investments that could potentially give 25% return on the investment. But other people can't afford to do that because they need to protect their capital, and they have to do something like a guaranteed fund that's going to give them a guarantee of 6.2% at this stage. Your needs, folks, every person's needs is different from the next person. It is therefore impossible to give anybody advice or recommendations on an open platform like this. Contact me. Myself or one of my advisors will gladly do an analysis for you and then make a recommendation. Okay. Thank you, Dr. T. Okay. SD says, how do I make sure that my beneficiaries use all my pension and retirement sparingly? You can't. This is the thing. You cannot do that. There's this old saying that lawyers sometimes use to say you can't rule out of the grave. And honestly, people try and set up trusts and wills and stuff with all these rules where they try and make people do what they want them to do. But at the end of the day, that trust and whatever is just as strong as the rules are. Now, if you've got beneficiaries and they inherit pension or retirement funds in their personal capacity, you can't do anything. You're dead. You can't tell them what they must do and what they must not do with the money. If the money is payable to a trust, well, then there is a possibility, depending on how caring and good the trustees is, the trustees have a responsibility on a trust to manage funds for people in a very, responsible manner, and to make sure that people get what they need, but at the same time to protect and to grow the money that's in the trust. So if you've got good trustees and the money goes into a trust, well then hopefully they will do their job properly, and they will make sure that your beneficiary always have money. But as soon as money pays out directly to beneficiaries, that's it. They can do with it as they please. And this is also why I normally say to people, don't nominate children as beneficiaries. Because that child, if they're underage, the money goes into their bank account, and the person that is their guardian, be it mother, father, uncle, aunt, grandmother, they now have access to their funds so they can use their child. And if their child gets to the age of 18 where they now can look off or deal with their own money, now they're still financially stupid. It's the only thing to say. And they won't know how to deal with the money. So when it comes to children, rather make provision in your will for a trust with trustees that you know you can trust, and say the money must go into trust for that child, and let the trust run until the child is 40 before they can disband it and give the child all the money. How much do you take for investment? Okay, sure. How much do you take for investment? It depends on what you have. I mean, when we are talking about recurring investments, meaning that you pay a monthly premium, I think the minimum that we can take these days is 550 or 750 Rand a month. And when you are talking about lump sums, single premiums that you want to make a once-off investment, I think it's 10,000. I stand to be corrected because not all the companies have exactly the same rules. But yeah, you're looking at 10,000 Rand as a lump sum, around about 550, 750 as a monthly income. Kerry says the S&P has never done better. I will not be surprised, Kerry. But again, I don't watch it on a full-time basis. Last time I looked at the S&P, I could see it was doing well. And every now and again, I have people that tell me that's the only place to invest is the S&P 500. And I'm like, okay, great, if that's going to work for you. But yeah, I don't follow the S&P religiously, just like I don't follow the JSE or any of those stock exchanges religiously. Kitso says they must not talk nonsense. I'm not sure who you're talking about, Kitso, but I'll accept your word for it. Donna says we need to come for a consultation. 100%, Donna. In my profile is my WhatsApp number. Send me a WhatsApp, and then from there I'll let you know how I work, how I set up consultations, fees, the whole tutti. Okay, thanks, Donna. Love yeah, Clark, I don't think they are listening. When he says, I think ETF ones are the best because of the low fees. So Wendy, here's my opinion about ETFs. I don't like ETFs. And yes, I know that the fees are low on ETFs. But ETFs is passively managed investments, and I like actively managed investments. And the difference between the two is on an ETF, the money gets put into a bunch of shares that maybe competes with the S&P 500. So it's in line with what the S&P 500 is in terms of shares. And every day they just rebalance this thing based on how those things in the S&P has gone up and down. On an actively managed fund, the portfolio manager can actually go and buy and sell. So on an actively managed fund, if the portfolio manager feels that a certain share is not going to do well anymore, he can sell it down, go buy something else that he thinks is going to do better. So especially when you've got good portfolio managers and fund managers, they can move quicker, and they can normally save you a lot of money or help you with more growth. Now, the thing is with regards to ETFs, and this is what I just want to say as a last thing to step off from it. People always goes on about the cost, okay, and the cost and the cost. So here's my thing. Would you rather have a 10% return on investment with a 1% fee because it's the lowest fee and walk away with 9%? Or would you rather have 14% return on investment with a 2% fee, which is now the highest fee, and therefore walk away with 12%? My personal opinion, I don't mind paying for good advice and for good products if I am going to get the value for money. So by all means, if you like ETFs, you keep on going. You can't go wrong because you will always get some growth on them. I just personally think that actively managed funds do better. What is your view about SA retail bonds over 5 years? Rainmaker? You see, tonight it's going to sound like I like nothing. Where's that one? Hang on a second. I just want to get back to, I see we're going to run out of time again tonight. SA retail bonds over 5 years. Rainmaker, I'm honestly not a big fan of SA retail bonds or SA government bonds. That's my honest opinion. A retail bond or a government bond is a guarantee return that you get on investment that you make, and it's percentage based. And at the end of the day, it's interest. And because it's interest, it's taxable. So if you get offered a 10.5% bond over a 5-year period, you're never going to walk away with 10.5% because you're going to have to pay tax on that. So I just don't like it. I think it is very safe. I think it's very secure. I think for people that wants to have absolute certainty and understands that they're not going to shoot the lights out in terms of the returns, I think it's a great thing. But for an investor that wants to build wealth, I'm really not a big fan. I hope that's answered it for you. T-Man says, can I switch to high-risk portfolio on my RA? I'm currently on a medium to moderate, age 44, balance 125,000. T-Man, you can indeed. Now, you must just remember that in a retirement annuity that is governed, these things are governed by Regulation 28. Regulation 28 says that you cannot have more than 75% shares and 45% offshore shares in that retirement annuity. 25% of your funds must be in cash, bonds, and property. So, the maximum risk you can go, so to say, is on a moderately high portfolio to get that maximum 75. So what I do, and what we do in our company, is when people want to move from something that is medium or moderate, as you've got it here, to a higher risk, is we actually go and build a portfolio for them. And we build the portfolio so that you are exposed with the different underlying portfolios, because we normally make use of 4 or 5 underlying portfolios. We built it in such a way that that portfolio is made up, and you've got now 75% in equity and 45% in global equity. And what this means is that your equity and your global equity portions are going to grow faster, much faster than the property, cash, and bonds. So within a very short period of time, you in any case going to sit with a portfolio that has got 80 to 85% exposure to equities, and that's what you want to have. So that's what you need to do. You either find a portfolio with a company that you're with that gives you those benefits, or you get somebody to build you a portfolio to that effect. So short answer is yes, you can. Long answers, it's a bit of planning that needs to be done. Thank you, Kerry. Just confirming there what I said on retail bonds. So basically, ST, a retirement annuity that I can cash in 5 years. I still have 15 years to retire. What's your take? Well, you cannot cash in a retirement annuity in 5 years unless you reach the age of 55 in 5 years. If you turn 55 in 5 years, at that point, once again, it's going to depend on your situation whether you should cash in your retirement annuity. I prefer that people stay longer in their retirement annuities and that they work longer, because we live longer. You need more capital in order to make ends meet. That's the first thing. The second thing is, if your retirement annuity effectively has to run, let's call it until the age of 70, because you're talking about 15 year or 65. If you get to the age of 55 and you now want to cash it in, take your 1/3, 2/3 options, the chances are very good that you are going to pay penalties on it. So, at this stage, it's way too far away for you to make a decision, but my advice now already would be, or not my advice, my recommendation now already would be, rather wait until you get there and preferably stay longer. People, think of it like this. If you have R1 million to retire with at the age of 55, versus the guy sitting next to you that's also got $1 billion, but he's at the age of 70. Who is better off? The one with $1 million at 55 or the one with $1 million at 70? The guy with $1 million at 70. Because his life expectancy is till the age of 80. He needs that $1 million to last him for 10 years. But you at the age of 55 have to let that money last for 25 years. So it is always better to wait until later in life to make sure that you're going to be financially secure. Okay. S&T is going to say the same thing to you. Possibly. Rental property investment or Investec investment account. So Quadraman, I'm not a fan of properties. I do believe, and I've seen lots of people that do very well with properties, but I am not a fan of properties, and therefore I will never advocate properties. Whether it's better to go property or this Investec investment account, that I can't tell you, because the Investec investment account that you're going to go for is once again going to be determined by the underlying funds and how well those funds are doing. And I can promise you that some funds are doing substantially better than what property is doing in South Africa. I know people don't want to admit it, but property in South Africa, the value of property over the last 20 years has declined over the entire South Africa, except for the Western Cape. The Western Cape is the only area in South Africa where property value has increased. So just think about that when you make that decision about property or investments. S&T for a consultation? I don't know what is for a consultation, but so be it. Unless you were asking me how much I charge for a consultation. I ask 1,500 Rand for the first consultation, and trust me, I'm very close to putting that up to 2,000 Rand. Whitney says, totally agree with you, sir. Thank you for all the extremely good advice. Appreciate it. Whitney, it's only a pleasure. Abel, how's it, Abel? Okay, Joe, great stuff. We'll make an appointment. Absolutely. Look forward to seeing you. Kerry, what information do you look at if not the JSE when advising clients? So, Kerry, when I talk about information, I look at you as an individual. What is your circumstances? What's your income and expenditure like? What is your assets and liability like? What is your family situation? Do you have financial dependents? People that are financially dependent on you? How aggressive can you invest? Because not everybody is aggressive. So there's a lot of personal information that I look at when I make a decision. And then once I have found out where I believe you should be in terms of the strategy, then I look at the portfolios that the company offers. And I choose a portfolio that is in line with your strategy where I can marry those two. And that's what I give you. And the portfolios, although the portfolio managers invests on the JSE and other markets, the portfolio is not linked to the JSE. So what happens on the JSE and what happens in the portfolio is completely different from each other. So that's what I do, Kerry. Oh, folks, it's almost time to go. It is actually time to go. So let me see if I can answer one or two quick. Was looking at a funeral cover, too expensive. Rather buy a unit trust with that money. What's your take? I don't like funeral cover. I do agree that it's too expensive. If you look at what the cost is for funeral cover per 10,000 versus what the cost is for life cover per 10,000, then you're always better off to go and take up a life cover policy. And for the same premium, you're going to get substantially more cover. And then when it comes to death, I always say that Afpop is not going to let you lie in the refrigerator until your family can pay for the funeral. Absolutely. They need to move your body because they have to put the next person in there. Okay? Sounds terrible to say it like that, but that's the honest truth. So any funeral house will go into an agreement with you as to how you're going to pay them. And if you can prove to them that the deceased had a life policy that will be paying out in 2 to 6 weeks, they will say, fantastic. Sign on the dotted line, give us a letter to say that you will pay us as soon as that money comes out, and they will help you. So the fallacy out there is funeral policies pays out within 48 hours and you need the money so that you can pay off Bob. Not true. But in any case, that's just my opinion. And yeah, unit trust is a good idea. You must just not pass away after you've only paid the first premium. Then you don't have enough funeral cover. Daryl says 14% for me. Great. Then you go with the Global Equity Fund, Daryl. Edrin, my RA shows last contribution next year, July. I am still working. What are my choices? Edrin, you've got plenty of choices. You can leave it after the last premium is paid and it will still keep on growing. So you can leave it where it is. It will still keep on growing until you want to take it. You can choose if you wanted to take 1/3 and the other 2/3 is monthly income, or just take a total income to supplement your current income. You can choose to carry on paying premiums, which is most probably the best of the ideas because then you are going to grow your RA even more. So you've got a number of options as to what you can do. Thank you for the advice you give. Donna, it's only a pleasure. Ferdi Boskind, interest of 7 million more or less. Ferdi Boskind, all I can tell you is go and have a look at what banks say on their websites with regards to interest, okay? It's going to depend on how long you put it in there. If you have a normal savings account with the bank, they might only offer you 6%. But if you do a fixed savings deposit with them, or fixed deposit as they call it, for 5 years, they most probably going to be willing to offer you as much as 9.5% or 10%. So there's a big gap in terms of what you can expect as interest. But it all depends on the type of product you're going to do. So go and check out your bank's website and you will see. Thank you, S&T. Everybody, I think that was it. Yep, indeed, that was everybody. Thank you very much for spending Wednesday night 6 to 7 with me. I hope you have a stunning evening and a fantastic rest of the week. And I'll see you again next week. And those people that said they're going to contact me, I look forward to getting your WhatsApp. All the best. Keep well. Bye-bye. All the best. Keep well. Bye-bye.